All right, welcome everyone. We're so excited to have you here at the Bank of Utah Ogden Weber Chamber Economic Breakfast. Again, thank you for being here. I'm Brandon Hanson. I'm the president of Bank of Utah. You know, we've been having these economic events for about the past 10 years now, and it's been really great to be involved in that and helping bring information to you to help you with your businesses and making decisions in your life. A lot of chaos, a lot of crazy things happening in the economy, and very excited to have two people here to help us better understand what's happening in the environment. Really pleased to be here with Chuck, with the Ogden Weber Chamber, partnering with him. I'll turn some time over to him. Chuck?
Thanks, Brandon. Can you believe it's been that long? It's been 10 years, and we have been just so fortunate to have such a great partner in Bank of Utah. Every time we turn around and something important comes that needs to be done in our area, Bank of Utah steps up. And Brandon, thank you for that great partnership. The bank is just a leader in this community, and it's one of the heart and soul businesses in this community. So thank you. Let's give them a big round of applause. We have amazing partners with a lot of our keystone partners. They're on your table. America First Credit Union, Bank of America, Standard Examiner, Business Depot Ogden, Staker Parson, Ogden City, and Weber County. They also are great partners of the Chamber, and thank you for letting us work together with those great partners as well. We have our officers. I just wanted to recognize quickly with us Aaron Osted, if you could, where are you at, Aaron? Right here, Aaron Osted is the chair of our chamber. Greg Sanders, the vice chair. Greg, where are you at? Thank you. And our treasurer, Nancy Collinwood. Right here, Nancy. And then Lee Dean is our past chair. And where are you at, Lee? Right there. Thank you, Lee. So thank you for the great work, the hours that go into helping the chamber run and do great, amazing things. Would you please join with me in giving these four individuals a round of applause? Thanks again, Brandon. It's a great morning and great to be with you.
All right, thanks, Chuck. Today we get the opportunity to hear from two really well-renowned speakers. I'm pleased to introduce to you the first one. Tim Mahidi is co-founder and chief economist of Access Macro. Tim works closely with regional and community banks, helping make sense of economic trends, inflation, and interest rates to help make better informed decisions. Before starting Access Macro, Tim was the senior economist at KPMG. He also served as the president's chief of staff and chief operating officer at the Federal Home Loan Bank of San Francisco. Tim's also spent time at Bloomberg, where he's been featured on television and radio. Please join me in welcoming Tim Mahidi to the stage.
Good morning. Everybody hear me? Okay, I'm going to stick this on. How about a round of applause for Brandon for having to read that horrible bio? Super long. Yeah, there we go. Thank you. All right. Okay, so this is Macro 101. I hope you've had your coffee. No laughs. Some people are already walking towards the exits. So what we're going to talk about today, one, thank you for I'm going to unmute me. Unmute me. There we go. All right, that's better. Feedback. Okay, I'll try to talk not super loud. Working on the mic, sorry. I have two small kids, and so I'm used to yelling at people. So I will try not to do that with the microphone on. All right, Macro 101. Thank you for having me out here in Ogden. It's great to be here. I am going to do my best impression of an optimist today, because really, it's not hard to be optimistic about our economy, right? So I'm gonna show you a bunch of pictures. Hopefully, it's not overwhelming. We're going to talk through a lot of stuff, and then we're going to reserve some time at the end for questions. So we're doing that because we've got mic runners. So thank you, folks, in advance for running the mics. But we're going to wait till the end, and then you can pepper me with all the questions that you want. I will answer anything. I tell people I run my own company, and the benefit is I can say whatever I want. Doesn't work with my wife. So, okay, where are we, right? For those of you that lived through last year and remember the headlines, it was doom and gloom at front and then better in the middle, right? So where did we end up? So what you're looking at here, this is real GDP growth, broken into 4 parts. I can see the glaze happening already. C plus I plus G plus NX. Anyone remember that from Macro 101, basic accounting? Oh man, this is going to be a tough audience. Don't throw anything at me. So basically, you can add 4 things together to get the economy. That's simple. Economists love to say they do math. We just do addition and subtraction all day. C is consumer spending. I is investment. NX is net exports. Exports minus imports. And G is government spending. There you go. That's the economy. 4 things. You're done. You've learned something today, right? C, by the way, is the most important piece. C is about 70% of our economy, consumption. Investment is about 15%. Government spending is 5 to 8 range. The rest is net exports. Now, in our country, we import more than we export. So generally speaking, that's a negative for us. So what I want you to pay attention to, so these are those 4 things stacked up together, so you can add them together. And then the black line is real GDP growth. Real meaning adjusted for inflation. Now, why do we have this? Because it tells you what was driving growth or subtracting from growth last year. And I just want you to look, you can ignore everything up to the last 3 bars, really. So we have data through the 3rd quarter of last year. We're a bit delayed. There was a government shutdown. We'll get more data for we'll get Q4 data at the end of this month. But I want you to just look at oh, look, the bars all look pretty normal. And then bang, starting in 2025, things get a little bit crazy, right? Blue gets big, green gets big. And so you can see the impact of tariff policy in real time starting in Q1. So that big negative blue, that's because everybody went and imported stuff in Q1. So we imported a ton of stuff. Exports stayed more or less the same. Huge contraction or pull down in GDP. At the same time, though, this doesn't get talked about as much. People went out and tried to buy investment goods abroad. That's the big boost to the light green bar investment, right? So that's a huge tariff impact. Some of it is offsetting, right? The green bar, we went out and bought investment goods. That's positive for the economy, but we then went and imported some consumer goods. That's negative for the economy, right? So there was a huge swing. And then in Q2, the reverse happens, right? All of a sudden, nobody's importing anything because we had tariffs. And so that means the blue bar goes up because we're not importing anything, and no one's buying any investment goods. So you have this massive swing in GDP. So you kind of have to take those first 2 quarters and go, I'm just going to put those aside. That's a historical anomaly. So let's look at Q3. Where are things? Well, it's interesting. There was almost no real investment in Q3. And then you have some positive from low imports again. What I want you to focus on is that black segment of the bar. That's the C. That's the 70% of households, of our economy, where households going out and buying things. Everyone in this room going to buy a new car, going to buy food, hopefully a new sound system, right? Let's boost that economy. And what's interesting is you would think that tariffs would really impact that C. But look at how the black bar is it's like stairs up to the mountain to go skiing, right? This guy's talking, I know this. He's from Southern California. You don't take stairs to go skiing. It's a lift, right? Well, it's just like stairs up to your house, right? So consumption was getting stronger throughout the year. That is not, not what most economists were predicting, right? This is a very, very positive story about the resiliency of the American economy. Has anyone ever heard the phrase, don't bet against the American consumer? Well, if you have, this is the picture that tells you why. Just blew right on through. So that's really positive for our economy. Now, some of you may also have heard that there were tariffs last year, right? We've all heard that, right? Yes, okay, there were tariffs. Still are tariffs. Well, that was supposed to be extremely inflationary, right? If you remember the beginning of the year, people were freaking out and saying, hey, these tariffs are really going to impact, we're talking 4 or 5% inflation. Now, there's definitely an inflationary impact, but as I'm going to show you in a second, we may have already passed the peak of it. There's other reasons to worry about inflation. Tariffs seem to be the thing that didn't show up in the same way we thought that it would. So what are you looking at here? These green bars, that's the month over month change and core PC inflation. I'm going to slow down for a second. There are two big measures of inflation in the economy. CPI, which you've probably all heard of, and PC, which probably few of you have heard of. Guess which one the Fed really cares about? The one no one's heard of, right? Economists always picking things. They're confusing and hard to understand. And so this is that measure of PCE inflation. Now the difference between those things is pretty small. There's just differences in how much they weight stuff. But that's technically what the Fed is targeting. Now I said core because that's taking out food and energy. Well, why would we do that? Everybody knows that you need to pay for food and you got energy bills, right? And that's because when you're a monetary policy, when you're an economist, you're thinking about monetary policy, you want to think about the underlying trends in inflation, and you got to take out food and energy because it moves up and down a lot. So what you're looking at here is kind of the Fed's directional inflationary measure. That's why I've got this up there. And the green bars are just a change from last month to this month, right? This month to next month. The black line we'll get to in a second. The dark green line, that's just a 3-month average. Just shows you kind of the momentum. Now, interestingly enough, let me ask this question. Does anyone know what the Fed's inflation target is? Anyone? It's a number. 10. Someone's from Zimbabwe back there. 10. I heard 2. Okay, good. 10. Oh, had a heart attack. It is 2, right? 2. So the Fed is trying to hit 2% inflation on a year-over-year basis, right? So this chart I'm showing you like, well, this month to last month. Year-over-year is this time last year to now. Think of it like this. Year-over-year is the speed of your car over an hour. Month-over-month is the speed of your car in the last 2 minutes. So if you're going, and I'm not going to point at myself, if you're going 85 down I-5 in California because your kids are late to school, and you see the sirens flashing, you can't go tell the police officer, look, but I was going 45 a minute ago, so we're averaging 60, right? No. They're going to hit you on what you just did. That's this chart. That's you're going too fast. So that black line, that's the month-over-month rate, the last 2 minutes of how you're driving, that's consistent with a rate of 2%. So if you're driving 60 miles an hour for an hour, you're driving 60 miles per hour. The black line is your speed limit. Think of it that way. So when the green bars are above the black, your year-over-year inflation measure is diverging from what the Fed wants. When the green bars are below the black line, you're converging or you're at where the Fed wants to be. That's what is so powerful about this chart. You can see how high and how much we were diverging from the Fed's target and how fast the car was going and picking up speed. But then look what happens in July of last year. You know, data moves around. You can see from earlier parts up and down, high, low. There's a continuous almost decline in the speed of the car over the last 6 months. That is very, very good news and extremely surprising given what was going on with tariffs and all of that. So when the Fed says, when Powell or anybody else says, hey, look, we're slowing down, the car's slowing down, this is the chart that they're thinking about. I want to put that in your head. Okay, so wait a minute. I heard about tariffs. I heard about all the chaos that's going on in the world. Why didn't we see more in those measures? Why is this guy talking about green bars being above black lines, and yet it's not like all the way through the roof, right? That's what I was told was going to happen. It's because up until this point, and I'm saying up until this point, businesses absorbed much of the tariff impact. So this is a chart that shows you corporate profits as a percentage of GDP, right? And you can see, now percentage of GDP is important. That means we took dollars of corporate profits divided by dollars of GDP. Why didn't we just take corporate profits? Because of inflation over time, it's monotonically up. It continues to go up. So you want to measure corporate profits as a share of something to get a sense of how big is it relative to our economy. And it's pretty big, right? We've a ton of profits right now going to corporations. And so that allowed them to absorb a lot of that inflationary impact and as of yet, not pass all of it on to consumers. That and the fact that they also were not enforcing the tariffs in the same numeric way at the border as they said they were going to. So there have been stories about tariff rates that are applied that are not actually as high as the announced amount. But both of those things have really helped to slow down and lessen the impact of tariffs. Okay, this is all really good news, right? This is great. Economy's going well. Households are spending. The doom and gloom that economists love to talk about not happening as much. All right, so if that's true, then why isn't the Fed back down? Why aren't we lowering rates again in January and March? And the reason is, let's go back to that car analogy. The speed of your car over an hour, the rate of inflation over a year. So even if inflation comes in below that black line, it's like a plane landing on a runway. It's going to take time for that 2% to come back down. So what you're looking at here are a couple different cuts of inflation, including our forecast, which is the dark green line. But this is just showing you, look, if I have a constant rate of inflation at different amounts, how long will it take for us to get to 2%? 2% is that black line. So 0.165, that's the rate consistent with 2% inflation over a year. So that's the speed, that's 60 miles an hour in your car. That's a black line from the other chart. So if you grow something for 12 months at that rate, it will drop down to 2% mathematically. And then you've just got two different inflation scenarios. The black line is kind of where we are right now on a 3-month average. The top line is where we were a few months ago. So these are not crazy numbers to pick. And the green line is our forecast based on our models. And what I want to show you is, like, under the best of assumptions, we hit 2% inflation towards the end of the year. That's very unlikely to happen, but that's the best of assumptions. More likely than not, we're going to still have inflation above 2% for all of 26, and it will go into 27. That's what John Williams, New York Fed president, has been saying. And so this is true and has been true for a while. In fact, if you think about where we were in the fall of 2024 versus now, or versus the end of last year, we made no progress on inflation. Core PCE inflation at the end of 2024, 2.9%. Core PCE inflation at the end of 2025, 2.9%. Zero movement. And yet 175 basis points of policy removal, right? That's not blasting the Fed. Those are just facts. We haven't even talked about treasuries yet. Okay. That's the good news. That's hey, we're making progress on our inflation target. Does anyone know, by the way, I should have started with this. Has anyone heard of the dual mandate? Bonus points. Someone's trying to look in the back. That counts as a yes. What was that? And? There we go. Stable prices and full employment. What is that gobbledygook that is coming out of my mouth? The Fed they have three objectives, but we'll talk about the two big ones. That's to keep prices stable and to have full employment. Those are intentionally ambiguous. What's stable prices? What's full employment? Well, we just talked about inflation. The Fed has defined stable prices as 2% price growth. Okay, cool, check, going that way. What about full employment? Healthy job market. Well, that has been the news for the last couple years. Does anyone remember what happened in the summer when all of a sudden people freaked out? It actually happened 2 summers in a row. The BLS revised data, and it was negative in terms of job growth, and all of a sudden chaos ensued. It happened in July of 2024 and early August, and then again in early September of 2025. And so and that's a large reason why the Fed has been cutting, is concerns over the labor market. Now, the economy is still adding jobs, and there are structural things happening to our economy that have nothing to do with AI that are lowering the amount of jobs you need to keep the unemployment rate constant. We have an aging population that's been going on for decades. That's bringing down your labor supply. You have immigration stuff that's bringing down labor supply. And you have some early signs of AI for younger workers. All of those reduce the number of jobs you need in the economy to keep the unemployment rate low because you have less labor supply. So, okay, I don't need 200K jobs a year. But so why am I hearing the labor market's weak if we're adding 50,000 jobs? This is what we got last month. And we'll know tomorrow just how many we got in January. Why is everyone freaking out? Because we have a fragile labor market, right? So what you're looking at here is a percentage of the number of jobs that were added by year from the healthcare and social assistance sector divided by the total number of jobs added. So the share of people, of folks hired in that sector, healthcare, divided by all jobs that were added. Okay, so you can see in the 2017, 2018, 2019, okay, 37, 58 is kind of a big year. And then all of a sudden, you start to see the chart go up, right? The concentration of job gains gets pretty serious in 23, 24. And then what happened in 25? How did you get 128, almost 129%? How can you be over 100? It's because there were more jobs added in that sector than across the rest of the economy because you lost jobs in other places, right? And so this sector is almost the entire strength, the single leg of the job market. And it is going through a transitional period right now with the changes to ACA subsidies and just high costs in general. Our pillar of strength is definitely being eroded. And so there's a lot of concern around the concentration of job gains, the loss of labor supply, the weakness in the labor market. It has not yet tipped over. And to be fair, we've been worried about this for a couple years. So there's no indication that tomorrow there's a recession, but we're tiptoeing closer and closer into a place where there could be significant job losses, which would trigger a recession. So that's where the fear is coming from. That's where the anxiety is coming from. Okay. So you've got your two sides of the Fed mandate. We're making progress, kind of made progress on one, although, inflation's still kind of high. Labor market's weak. Okay, where should we stop, right? If we're the Fed, if I'm the FOMC, where do I stop in this world? It's very unclear what's going on with the data. You've got questions around future policy. So what do economists do? What do we always do when we're worried about stuff? We create a video game model that tells us this is what you should do, right, with numbers. And that's what this chart is. So think of it this way. There is a growth rate in the economy that is optimal based on the structure of the economy. Could be 2, could be 1.9, could be 1.8, could be 4, right? And you could just think the stronger the fundamentals of the economy, the higher that optimal growth rate would be. Well, that optimal growth rate is associated with an optimal interest rate, right? Okay, so if you have higher growth, you can have higher interest rates, right? The economy is able to absorb higher credit costs. If you have lower optimal growth, you have a lower optimal interest rate. The black line is an estimate of that optimal interest rate. It is not real data. It's a video game. But it's a kind of measure. It's a baseline for, given what we know about the economy and all the things we can throw into our model, what should the optimal real interest rate, the interest rate minus 2% inflation, be based on what we know? The green line is what the Fed is actually doing, adjusted for inflation. Sorry, this is nominal space. This includes inflation. So this is what is the Fed actually doing. The green line is what you'll see in the newspaper. The black line is what's optimal. And what you can see, anyone ever heard the Fed causes recessions? Anyone ever heard that? Kind of, maybe, Bueller. Yes, this chart is an example why. Green goes above black. It means the Fed has raised to a level that the economy cannot sustain. Bang, you get a gray bar, which is a recession. Right? This is pretty standard kind of macro 101. The Fed overdoes it, right? Problem is you can't see the black bar really well in real time. This thing gets revised constantly. Has all kinds of issues. So you're not really sure where you are. But look, there you go. Green above black, 2008. Now, that's not the only reason, but that's something people will point to. And then if you look, what's abnormal is if you look out where we were just a few years ago, green is above black. Actually, pretty far above black. Those bars underneath, the like dark blue gray, that's the space between those things. You can see we were pretty elevated, but yet no recession. This blew economists' minds, right? This was a ton of monetary policy restriction, and yet here we are, like 4.3% growth in Q3, right? Like what happened? And you can see that black bar. See how the black line kind of jumps up after the pandemic? Well, there's reason to think that the pandemic didn't cause this, but things that were happening in our economy that were already kind of on their way jumped and became stronger tailwinds to growth after the pandemic. One of them being artificial intelligence. You have investments. You had just kind of people coming out with all the government stimulus, buying more stuff. And so it lifted the optimal rate of the economy, the growth rate. And then the green bars started to come down. So if you're thinking, where is the Fed likely to stop or what's the range? It's when green meets black. And we're kind of already there, right? We're very close. So that should tell you not to expect, in the current set of data, not to expect a whole lot more policy easing. Maybe a cut or two if the economy stays strong. But we're entering a new world. Look at how low that green bar was for all of 2010. It was 0. We're going back to the old world where the Fed funds rate's 3.5%, 4%. So this is where we are now. Higher rates, less policy accommodation. Okay, well, that's what I'm telling you. I put a model up against what was happening in real life. What does the FOMC think? The FOMC is the Federal Open Markets Committee, right? Those are the folks inside the Fed that make decisions about interest rate policy. Anyone know how many Fed meetings there are a year? Just throw out a number. It's not 10. 8! 8! That's right, 8. Look at how excited he gets about Fed meetings. How sad is that, right? My kids do not think I'm cool. Is that normal? Okay. So 8 meetings, 4 times a year, they actually produce numbers to tell you what they think of the economy. March, June, September, December. They give you a whole bunch of data. I used to do this for Mary in San Francisco and John before her, where they say, hey, here's what there are 19 people on the FOMC. 12 of them are Fed presidents. Your Fed president is San Francisco, Mary Daly. They all submit data, and then they take the middle of the data, they line them up, and they say, this is the middle of the data, and here are the range of estimates for different variables. Right? So you get a real-time assessment. We all get a real-time assessment of what the FOMC thinks about the economy and interest rates. This is that data going back to 2015 when they started doing that under Ben Bernanke. So the green line, remember I said 19 people submit forecasts, and then they line them up highest to lowest and take the middle, the median. The green line is the median, kind of the middle of all those forecasts. The gray space is something called the central tendency. That's the only time I will use statistics speak in this presentation. That's just take all those 19, throw out the top 3 and the bottom 3. It's kind of the space you're left with. So it tells you like how much agreement is there, right? When the gray space is narrow, then people agree on the FOMC, kind of where interest rates should stop. So this is where they think interest rates should stop. It's the long run rate of the federal funds rate. So this is like they ask them the question, where do you think the interest rate should be in the long run? They write down 3, right? Where we should stop essentially. The green line is the middle of that. The gray space is the central tendency, the range of that kind of. So you can see gray explodes post-pandemic, right? People all of a sudden, we have no idea what it is or where we should stop, but it explodes up. Just like I showed you in this chart, the black line jumped, right? The black line jumped. So too do people's views, the FOMC's views of where they should stop. But the green, what's interesting is the whole thing jumped up, but the green line's kind of in the bottom half of that, right? So that tells you there are people with forecasts on the FOMC that we're basically already done, but most people are still thinking we've got a little bit more to do. That's why I said, 1, 2 more cuts. But again, we're not going back. You can see the clear upward shift in the FOMC's views of the economy. I'm just trying to level set for you that as much as I would love to go back to a world where I could afford a home because interest rates are at 2 3/4, that's just not where we're headed, right? For a whole bunch of reasons, that's not where we're going. And it's partially because we've had these structural shifts. I'm going to go a little bit faster so I want to get to the Kevin Moore stuff. But this is interest rates. These are 2 interest rates. That's the federal funds rate, which is the green line I just showed you, and then the 10-year treasury rate, which is a benchmark interest rate in our economy. Mortgages are tied to it. A lot of investment is tied to it. And so these are 2 important interest rates. Short-term interest rates green, long-term interest rates black. And you can see for many decades, even though we had ups and downs, there's just a clear decline in the financial markets over what they're asking for compensation. Some of that's because the Fed lowered rates. A lot of it's because there was a lot of credibility that had been won over that period of time, right? And then look what happens post-pandemic. all of a sudden both of those jump up. But I really want you to focus on the black, the 10-year treasury, because that's not controlled by the monetary policy. The green bar controlled by the Fed. Up, down, green line, up, down, up, down. The black is a market rate. It's not only shifted up, but it looks like it's kind of hovering there now. This is the beginning of what looks like a structural change in our financial market. Now, what does it mean when that goes up? It means people want additional compensation for something, right? If I'm asking you for a higher interest rate, it's because I want you to pay me more for the money I'm giving you. Well, there's reasons for that. But one of them is, and what's driving this, is simply risk. We live in an uncertain time from human and economic history. In this country, particularly at this moment, there's a confluence of factors that are just coming together to make things very uncertain. So when you come to me and say, hey, you're the U.S. government, you say, hey, I want you to buy our bonds, I'm going to say, yeah, but I don't know what it's going to be like in 10 years, so I want an extra 3%. That's literally what's going on. Thus, inside of those markets, you can see the risk premium rising. And so this is not going away. This is what's going to drive the next decade or two of interest rate policy in our economy, and why we should expect rates to stay elevated. It's nobody's fault. It's not like everyone's out there with, trying to go grab their, what they can get. It's because risk is being repriced into our economy in a way that we just don't remember. This is how it used to be prior to the 80s. We just forgot about it because the Fed Volcker did such a good job of slamming on the brakes, and the economy was there were crises, but relatively calm period of time in our economic history. We are leaving that. Doesn't mean that it's going to be all doom and gloom. It just means there's going to be more volatility, and people want to be compensated for that. So that's where we are. Now, done with the line charts. How are we doing on time? Okay, we're doing all right. So, I went quickly through that. Now, something big happened a few weeks ago. I've got a couple slides here I want to talk to you about. Who here heard about what's going on at the Fed this year? Oh, I shouldn't say that. There's 5 things going on at the Fed. Legal issues aside, who here has heard what is going on at the Fed? Did anyone hear about the new nomination? Oh, we got a hand. Powell is going to be done, right? We think. Talk about that. So there's a new champion arising. His name is Kevin Warsh. He has previously been at the Fed, by the way. Kevin Warsh was a governor. Well, I should stop for a second. Let me just do a little Fed 101 here. This is the time to go get the coffee. Our banking system, our Fed system, is quite unique. It's really interesting how it was set up in 1913. So there's a board of governors in D.C. So when I say the board of governors, those are the folks in Washington, D.C. Now, there's a lot of people in D.C., but there are 7 governors. Now, D.C. is a .gov. It's an actual federal agency, .gov. Weird connection. It's not like of the other agencies, but it's technically a federal agency, .gov. 7 governors on the board in Washington, D.C. They are nominated by the president and confirmed by the Senate. They serve 14-year terms, and the terms don't all end at the same time. So the 14-year terms kind of roll this way, right? Roll this way for you. So that's the board in D.C., 7 of them, federal government. Now, my old employer, the San Francisco Fed, is actually not a .gov. It's a .org. It is not part of the federal government. There are, in fact, 12 regional banks, each of them with a president, and none of them are part of the federal government. They share a budget with the board in D.C., but the nomination process for the presidents is very different. This actually was a big deal. It should have been right now. It happened last year. Those presidents, like your president in San Francisco, are appointed by businesses and banks in that region, right? So it has nothing to do with D.C. D.C. technically confirms the presidents, but that's a rubber stamp, which we'll talk about in a second, was not so rubbery this time. But so they are basically outside of the national political process. All 12 of them show up in Washington 8 times a year to be all 12 of those presidents to be part of the FOMC. So that's where you get your 19. 7 people appointed by the president in, different presidents and confirmed by Congress. 12 of them brought up kind of organically in a federalized system from the rest of the country. The reason we do that is because we want to avoid influence in our central bank, which until last year was something that we read about in textbooks. Now we get to live through it, right? So that is really the whole point of this, is to have a system that is outside of political influence on whatever side of the aisle. You do not want central bankers being influenced by anybody, because then you get 10% inflation. Then your 10% inflation target is the optimistic scenario. You are in Zimbabwe or Argentina, not to pick on anybody, but you're in one of these countries where you want to get to 10% inflation because you get 20% a year. Credibility of the central bank is very important. It's the foundation of all modern monetary economics. So that's the system of the Fed. Now, those governors in DC I told you about, the 7 of them, they get to also sit on things called committees, right? One of them is the FOMC, and one of them gets to be in charge of the FOMC and in charge of the Fed. That's Jerome Powell. What's interesting is his term as chair is 4 years, ending this May. Term as chair of the FOMC and head of the Fed, chair of the Fed. But his term does not run out as a governor until 2028. This is the big discussion right now. Is Jerome Powell going to leave when his term as chairman is up? That's not the same. He doesn't have to leave. It is precedent that he leaves. Bernanke left when he was done. Greenspan left when he was no longer chair. Janet Yellen left when she was no longer chair. That is the tradition. But he does not have to do that. Right? So that's the big question. So, okay, we have and it's very up in the air as if he will or will not leave. I think he will stay. Our view is that he will stay. But 3-4 weeks ago, our view was that he was going to leave. The subpoena really changed things, I think, inside the Fed. And so, for those of you that don't know, the Fed was served with a subpoena about a month ago, and said they were breaking the law. So, over the building that they're building in DC. And so, that, I think, motivated him to stay on. So we'll see about that. But even if Jerome Powell stays, President Trump will get to appoint somebody as the new head of the Fed. And he just nominated Kevin Warsh. So that's where we are, right? I'm lining all this up because there's about to be a lot of discord at the Fed. Now, there were 3-4 choices. Trump picked the one right in the middle in terms of, influence versus credibility. Warsh is someone that agrees with some of the things the president has said, but also is an independent banker and his views have not drastically changed over time. The things he's saying now are the things he was saying in 2008 when he was integral in the post-financial crisis kind of cleanup. He's against QE. He is against balance sheet expansion. What does that mean? The Fed has a balance sheet like a bank. They go out and they mop up assets, treasuries and MBS after the global financial crisis to provide liquidity to the market and take bad loans off of balance sheets, right? So that really exploded and became a policy in 2008, and that policy was continued and then reactivated in the pandemic. So the Fed balance sheet for buying treasuries, particularly treasuries, but MBS, exploded. Who's heard of QE? Okay. That's when the Fed bought a lot of stuff. QT, quantitative tightening, is when the Fed's trying to get rid of that stuff. We bought all this stuff, our balance sheet exploded to 7 trillion, and we want to get rid of it. We've pumped all this money in, right? The balance sheet is the Fed goes out and buys a treasury, gives you money, and takes the treasury. Goes out and buys a mortgage-backed security, gives you the money, takes the mortgage-backed security. That's expanding the balance sheet. That provides money to the economy. Well, then they do it the other way when they want to take money out. They go sell, or in this case, they don't reinvest, and then that money is kind of mopped up, and it decreases the money supply. This is very integral to what Warsh is talking about. And so the Fed has been not reinvesting or shrinking the balance sheet for a little over a year, 2 years-ish, and they just stopped. So they're like, okay, we've reached a level that we no longer want to reduce the balance sheet. We're going to stop purchasing or stop removing these securities, right, from the market. And the reason is they're worried that they'll something called reserves, what banks hold at the Fed for their, like to cover losses and they need things like that those reserves are going to be too small. We don't want an economy where the banks don't have reserves. We don't want an economy where there isn't money out there to get, for you to put in the bank accounts. The Fed stopped. And Warsh says that's a big problem. The balance sheet was like $1 trillion before 2008. Even after the recent shrinking, it's still $6.6 trillion. So Warsh is saying, hey, look, here's the problem. The problem is the Fed could have lowered interest rates more, but because they have left so much money on their balance sheet, because they pumped so much money into the economy and didn't take it out starting in 2008 and going until today, they actually have increased the underlying forces of inflation, which has made it harder for them to cut interest rates, right? So here on the diagram, inflationary pressure on your left, Fed credibility on your right. That credibility is very central to Warsh's argument. His argument is logically consistent in a very specific world. And in that world, it's the Fed is not credible. The Fed has lost credibility when it comes to the inflation target. There is some evidence that the people are concerned the Fed is not serious about 2% inflation, right? There's not a ton of evidence, but it is not crazy to say, wait a minute, we've been above 2% inflation for going on 6 years, probably into 7. Do you guys actually want to hit 2%, or are you just kind of like saying 3% is fine? Right? That's a loss of credibility. Those are murmurs and things that make sense, but credibility is not just this little thing, right? You have to lose a lot of it. All the credibility is one under Volcker. So his argument is, look, they've lost credibility. The Fed has had to keep lower short-term interest rates high. And so what we really need to do is unwind the balance sheet. We'll get to the second thing. What we really need to do, his solution, is shrink the balance sheet. This is the panacea, the magic to all of this, right? If we reduce the balance sheet, it reduces inflationary pressure. The Fed becomes credible again. And then we say, oh, everything starts to work. We can then, because we've shrunk the balance sheet, we can now lower rates, because that's one of the things that was keeping interest rates high with this underlying inflationary pressure. Well, at the same time, if the Fed's more credible, then the financial markets will not ask for so much compensation. Remember that 10-year Treasury jump I showed you? The black line jumped up. Some of that is uncertainty about inflation. Well, if the Fed has a credibility problem, and that credibility problem is tied to the size of the balance sheet, and the Fed all of a sudden addresses that problem in Warsh's solution, then you should actually see the longer term rates go down as people say, now I know the Fed is committed to 2%. I'm going to ask for less interest rate compensation over the next 10 years. I'm going to lower that 10-year rate. So in Warsh's solution, with a more credible Fed, all interest rates go down. I'm making this point for a reason. I'm about to show you the opposite of this. So in this situation, Warsh is saying Fed gets credibility. Fed can now lower short-term rates. And because of that, long-term inflation expectations will come down. They're not super elevated, but in his world, they'll come down more. And then that will lower long-term rates. And all of a sudden, borrowing costs are much cheaper across the economy, right? That is just to be clear, that is a logically consistent argument that makes sense if the Fed has lost tons of credibility, and the reason is the balance sheet. The issue is that we very likely have not reached the level of credibility loss that would make that happen. Yes, again, there are concerns, and there should be concerns about whether the Fed intends to hit their they intend to, whether they can hit their 2% inflation target, right? That's what financial markets are saying when they ask for more risk premium in their 10-year Treasury. But here's the issue. Long-run inflation expectations in most surveys, including financial market surveys like TIPS, where people price in, you can back out and price in inflation, people's expectations of inflation, are not super elevated. They're a little bit higher, but not super elevated. Okay, so what happens if Warsh gets what he wants, but the world is not how he sees it? Well, in that world, you start to run off the balance sheet, right? Here's the problem. When you run off the balance sheet, you're dropping treasuries into the market and taking money out of the market, right? I'm getting treasuries off of my books and giving them to you. Well, that's a supply increase. Everyone in here, with your businesses and services, If all of a sudden there's an increase in supply, does the price go up or down for your goods and services? Down, right? All of a sudden there's a huge increase in supply, prices go down. Same with bonds. In finance, bond prices and bond rates move in opposite directions. Price of a bond goes down, the interest rate on that bond goes up. I have to entice you now to come in and take it, right? There's more of them. The price is going down. I need to compensate you more in interest rates, right, in the future to hold this bond. So bond prices and bond yields move in opposite directions. So if Warsh comes in and lowers all of those and shrinks the balance sheet, floods the market, and there isn't a credibility issue, all of a sudden the supply of bonds hits the market. It actually raises the 10-year rate. It's the exact opposite of what the president wants, particularly in the housing market. And that's because in that world, there isn't a significant credibility issue. Long-term inflation expectations don't come down, and the 10-year doesn't come down because they're not actually worried about inflation that much. They're worried about other stuff, right? So that's raising the 10-year. Well, what happens in that world? If he gets what he wants, he still lowers the federal funds rate, the short-term rates. So you have a real steepening of the curve. Short-term rates down, long-term rates up. This has been reported in the news, and this is what would happen in that world, right? Now, there are winners and losers like in everything. It really helps consumers because most of us, credit cards are tied to short-term rates, short-term business financing. It's helpful. Banks have better net interest margins, and net interest margins have been crushed over the last couple of decades. That's good. First-time home buyers, refinancers, investment all hurt because that 10-year goes up. So this is the real conundrum of what his views are on reducing the balance sheet. And to be honest with you, the balance sheet's a huge issue. It's not clear where that should be, and it should not be as high as it is, but we just can't get out from underneath it without doing something like this. So the problem is, what do we do with that? His solution is attack the problem head on. Well, if you're willing to accept the cost of that, then it is a fair solution. But there are costs that come with that, right? Now, do I think that Warsh will be successful in that? 2 minutes? Okay, thank you. Do I think Warsh will be successful in that? No. That policy is the exact opposite of what a lot of other powerful people on the FOMC are in favor of. Lori Logan in Dallas Fed, John Williams, my old boss in the New York Fed now, they're against this. So is Governor Waller probably, who's a governor in D.C. So Warsh is going to be met if he actually does this, which I don't think that he will right away. Warsh is a smart guy. He's known as a consensus builder. But if he comes in and starts trying to do that, there will be chaos inside the FOMC. You may actually get monetary policy decisions where the chair of the FOMC is dissenting from his own committee's vote. That's wild. So this year could be one that is very confusing from a Federal Reserve communications perspective, right? Now, all of that stuff, come to that in a second. All of that stuff, what happens to the thing we care about? 30-year, right? So for those of you that have been following along, 10-year Treasury linked to the 30-year. The 30-year and the 10-year have had extra stuff baked inside of it. So on top of that chart I showed you with the 10-year going up, then the spread between the 10-year and the 30-year has also been elevated historically. People have wanted extra compensation inside that 30-year. Well, very recently, the president told Fannie Mae to go buy $200 billion in MBS, and it essentially brought that spread back down to historical levels. So there's some positive and some relief for home buyers from public policy, but it could end up changing again should Warsh get in and get what he wants. Now, it's not saying I'm against Warsh, thank you, but it is to say we need to be thoughtful about what we're doing. So I'm going to stop there. I have one more slide. We can, talk about, if we have don't have any questions, but I'm going to pause here. Does anyone have any questions? We've got mic runners. I will literally answer any question that you want as honestly as I can. I'm quite good at ducking and dodging, so if you want to throw stuff, I'm going to shake on. Does anyone have any questions? Anything we've said, read, heard? Depreciation of the currency. One in the back. Yes, sir. Wait for a mic to reach you. Or shout it out. Or over here. Oh, we got a mic over here. Great. Yes, sir. You have the power. Ah. I like you. Mine. Mine, of course. Are we talking about Jamie Dimon? Yes, okay. Mr. Diamond is an interesting individual who seems to be of late on the wrong side of all economic forecast. Now, those who live in glass houses should not throw stones. I live in the glassiest of glass houses. But there are things that are being said that I think are more related to what Jamie Dimon is trying to get, particularly around the credit card caps, than I think really warrant in the data. We have been worried about these things in the data for a while, and we are not like driving clean and fine in the economy and everything's good to go. There are significant risks. But AI is a boost to productivity. Consumers are still spending. Even this morning's retail sales report was like down, but some of the sectors that are related to like, discretionary spending were fine. So it's going to take more, and the Fed is now in a downward cycle. It's going to take more than what we've been through to knock consumers off, in my view. So I am less concerned about a recession now than I was 6 months ago. But we'll see. You can all hit me up in 6 months when Jamie Dimon's right and say that's why he runs a bank and you don't. Any question? Yes, sir.
Thanks for your presentation. Curious what you might view the case for resurging inflation could be. What's the likelihood of that happening? Call it
2026. I think that is a really fascinating question. So I'm going to go all the way back here. I want to show you this. So the question is, what about resurgent inflation? Well, I told you tariff policy hasn't been as big of a deal as we thought it was going to be, right? None of you heard me speak, I think, 6 months ago, so you have no idea what I was saying at that time. I was 100% right. I was concerned about tariff inflation. It turns out that didn't end up happening, right? The models showed something that didn't end up occurring. Now, that doesn't mean there aren't inflationary risks this year. They're different, though, and they're not talked about as much. So, not to pick on anybody, but healthcare insurance costs have skyrocketed. Premiums, all of that. That's because, from what I've understood and talked to people in the industry, is because hospitals and service providers lost a ton of money during the pandemic. They then raised prices post-pandemic to recuperate on costs, and that has now been reflected in insurance prices. That's a long-running issue that's likely to continue with us for a while. So while it's a small section of overall, well, depends on the measure, a small section of overall spending, that's an inflationary spot. Now, that will show up this year. There's a huge increase in premium costs, 18% for people on the exchange, 11% by some measures for small businesses, on average, insurance premium costs. That will show up somewhat in this month, but that stuff is tabulated, that data is collected and analyzed when the policy rolls off, which isn't always the first of the year for some folks. So there's likely an inflationary impact throughout the year from that. The other thing that I am very scared about, I graduated school into the financial crisis. My first job was as an energy consulting analyst on the East Coast. So I know a little bit about power markets. And this is talked about, but I don't think the scale of it is properly understood. The energy demand consumption from AI investment is astronomical. And yes, some of them are building facilities for power generation in their own facility they're building, but it's going to be dwarfed. That generation will be dwarfed by the need. You can see it when like Claude, which is a major AI, came out today or yesterday, their margins were down because their cost of running their models is higher. They mean energy, right? The energy costs are astronomical. There's already reports about what's happening on the East Coast for heat and things like that. That's going to continue. We didn't do the investment we needed to in our energy infrastructure. We didn't build enough of whatever power that you think is the best power. And now we're in a spot where we can't, until there's a turnaround in this investment for data centers, which doesn't seem like it's happening anytime soon unless there's a recession, there's going to be a real push on energy costs, which are going to filter through to the rest of the economy, transportation, all that, manufacturing, all that stuff. So that's another spot. I don't expect it to go to 5, but I also wouldn't be surprised if this trend kind of stopped and reversed a little bit. We got back up to the 0.2s, right? Which is going to keep us above that 2% target, right? We're just now getting to where we need to be for inflation to come down to 2. And if these other things, these structural things the Fed has no control over, continue to push up prices, if you don't restrict the economy and just cause demand destruction somewhere else to offset that, you will get higher inflation. People are waking up to this. So keep your eye on those 2 things, health insurance and healthcare costs and energy costs over the next couple of years. I think those are places we could see not 5%, but maybe continued 3% or 3.5% year-over-year inflation. Got any other questions? Looking around? Bueller? Oh, come on. No one wants to talk about depreciation in the currency, the loss of the dollar's power. Oh, we got someone over here?
When we watch the financial news and read articles in financial periodicals, we often see this story about tariffs being inflationary. But my understanding is that the vast majority of sort of deeper analyses of economic research have found tariffs to be deflationary because of its 2 effects. One, of course, is I'm going to increase the price of imports, but the other effect is I'm going to have less economic activity in the long run. This, of course, will then be, I mean, this is a big part of the story of past very large recessions and depressions, and I just wondered if you have thoughts about that. And I think that actually ties into what you're talking about. So if we think about 2007, famous stories of people like anybody who bets against the housing market is insane. Housing prices always go up. And we can, like, I can kind of see this nowadays, like AI investment. Like anybody who would be against that would be crazy. But I mean, I can imagine a story of a lot of money sitting around. People don't know what to do with it. Okay, I'm going to throw it at the hot thing. And that seems like a story that actually repeats itself in our economy quite a bit and ties into other things like Feds cause recessions. So, any comments on that?
No, those are great questions. We've got 2 questions in there. One, you let me off the hook. You could have really punched at me with that paper. So I think what you're referencing, there was an economic research paper that came out of my old employer, the San Francisco Fed. A very interesting paper that said, wait a minute, tariffs over the long run are actually deflationary because there's demand destruction, right? Because the tariffs do so much damage to consumers that it ends up being disinflationary or deflationary over time. That paper, without going into it, there's some interesting findings in that. It's more of a long-term view than a short-term view. The impulse is still kind of up and then down, but there's good argument for that. What's interesting, this is where the models depart from, and I think this plays into both the chart I showed and kind of what you're saying. How the policy gets enacted matters. There are increasing stories now that the tariff rate that's actually being charged at the border is significantly lower than the written down on paper rate. And so that is potentially one of the reasons why we have not seen the same inflationary impulse. In that model, though, you are correct. If you keep tariffs at that level or continue to increase tariffs over a period, over a 3-5 year window, yeah, that's a very possible outcome, is that we've destroyed enough demand. The black bar here gets so crushed that we end up having deflation. So I think that's a fair point. It's not a short-term, necessarily this year, maybe end of this year kind of timing situation. Around the AI investment, who's heard of the tulip? Who's heard of the tulip investment in the Netherlands in the 1700s? This is the classic bubble story, right? Oh, yeah, we got one back here, right? Crypto, another one, right? AI, is it another one? We have an insane amount of investment that's being poured into these things, and it almost feels unreal, right? Or maybe it does feel unreal. And some people are actually taking bets against it, right? The gentleman, his name, I forget his last name, Michael Barr or whatever. Yeah, he's actually bet against AI investment right now. He shorted it. And so there's just a lot to say that, yes, there could be a bubble, but there's also real demand happening there around data center usage. It's not clear to me exactly where that ends up, but I would not be surprised to see some reversal in both asset prices and in AI investment down the road. Thank you so much for having me. I appreciate it. I'll be around if you have any more questions.
Fascinating. One more round of applause. Great job, Tim. So for many years, we've had a great resource here available to our county, to our region. And Michael Jean-Fro has come with us again this year, and we're so grateful for you, Michael, and spending your time and for all that you do for our community. I know there are many businesses who reach out to Michael independently and to get consultation and direction about what's happening here locally so that they can make proper decisions with respect to their business. We hope that you're one of those. And I'm not going to push all kinds of business to you, Michael, but I know that a lot of businesses are doing that, and that makes my heart really grateful for you, and that we have such some strong government leaders, and especially in the Department of Workforce Services. So it's my pleasure to introduce Michael, who's a senior economist with the Utah Department of Workforce Services. He specializes in labor markets along the Wasatch Front and the Bear River regions. And he is especially talented at making complex data accessible and actionable. And you'll hear that here in a second. He provides businesses and policymakers with some incredible, valuable insights. He holds a bachelor's degree in financial mathematics, as well as quantitative economics. And my favorite part about Michael that I always like to say is that outside of work, he enjoys beekeeping in the Beehive State. With that, let's welcome Michael to the stage.
Well, let me get this set up real quick. Hello again, everybody who was here last year. I'll break everything before I start. I'm honored to be asked to come back again. And thank you very much, Tim. There were great insights there, especially from the background of monetary policy and everything. That was fantastic. At DWS, we do focus a lot more on the labor market side of things. DWS, the Department of Workforce Services, has a big umbrella with a lot of different services like refugee services. We administer unemployment insurance. And for us, at our shop, it's called a Labor Market Information Shop. We kind of keep our finger on the pulse of the labor market. We create the county unemployment rates for all of the counties in Utah. And so we're going to be looking at the the economy from a little bit of a different lens. Hopefully it's a bit of a palate cleanser so we can dive into this again and it feels a little fresh. We can all, get reinvigorated. The things we're going to look at today in short are the labor market and where we're at currently, and a little bit about the job market, some of the housing hurdles that we've had that kind of dovetails into what Tim talked about with the federal funds rate and what that looks like in housing affordability in Utah. And then some forecasts and expectations for our little state and how we're going to fare over the short term and a little bit in the long term. In the labor force and job market, there's kind of a couple points I want to talk about. Utah, as usual, continues to outperform national metrics. There's a few reasons why, and we'll get into that. But there is kind of a Russian nesting doll effect where we are not completely divorced from the rest of the nation, right? We're a fairly small economy compared to some of the larger states. But we definitely have really strong labor market metrics, continue to grow at really healthy rates. There is some cooling, and we'll get into that, looking at job opportunity and labor turnover survey data that we get from the BLS. And then we're going to look at a little bit of a zoom in on northern Utah, just because up here things are a little bit different than the state as a whole. So first, to look at the entire state, on the left is just essentially a heat map of where things are growing, where things are slowing down. We get the darkest, most bold of red colors because we are one of those high flyers. We're fifth right now for job growth year over year. This is December 2020-25, which is our most recent data for state-level growth, which means we're doing pretty well, especially compared to some of our neighbors who are slowing down a little bit, although slowing down is a little bit of the name of the game right now across the board. Comparing unemployment rate seasonally adjusted, which takes out, for example, in Utah, specifically in some of our rural counties, you can see really, really big changes between summer and winter employment, depending on what kind of tourism they use, for example. So trying to smooth that out, you can see kind of this comparison I want to point out here. The red line is the unemployment rate across the United States, which tends to be higher than the unemployment rate within Utah, just more evidence of us being one of those high flyers. At the end of this last year, again, the most recent data we have is December 2025, Utah had an unemployment rate of 3.6% compared to the United States' 4.3%. Now, one thing in this that I hear all the time is when I point this out as a labor economist that we have really low unemployment rates, Everybody has an anecdote about their nephew, their neighbor, their cousin who finished school or got fired from the job and is trying to find another job, and they can't. And yet this unemployment rate shows that, well, shouldn't everybody who's trying to find a job be able to get one? Only 3.6% of people are unemployed. And really, part of what's happening here is there's a story that gets lost in how the CPS, the Current Population Survey, actually measures unemployment rates. So to remind people, because everybody I'm sure already knew this and just forgot, the CPS, Current Population Survey, goes out and asks people specific questions about their behavior and interactions with the job market. And the questions you get asked that determine these kinds of rates are basically 3 questions that matter, which is 1, are you working at all? Are you interested in working? And if you say no, you're not in the labor force, right? You just don't even count. Are you working? Great. You're employed. You're obviously in the labor market. And the only people that fall into this unemployment rate are people that get asked, have you looked for work in the last 4 weeks? It could be driving down the road and looking for signs in windows. It could be getting on a job search engine, Indeed, trying to find something and updating your resume. But if you haven't taken proactive action in the last 4 weeks, you don't count as unemployed. And there are actually more metrics, don't let the multiple lines scare you, there are more metrics around people's involvement with the labor market that actually fits those anecdotal stories a little bit more. So when you look at the unemployment rates, there's additional rates. The one we use right there is called the U3. There's 3 components, not in the labor force, and then unemployed and employed. This goes up to the U6 rate, which includes other people. There's a bunch of jargon at the top because this is taken from FRED, which is a fantastic database from the federal banks. And it includes a little bit more of those metrics. So the other questions that they don't include in the base unemployment rates that are pretty interesting are things like, have you given up looking for work because you've put in a ton of resumes, you've applied to all these jobs, and you haven't gotten anything back? Or you've given up because you have decided you and your partner are going to change. One of you is going to stay home because childcare is getting really expensive and you can't find a job that pays enough to offset that cost to make it worth it for both of you guys to be in the labor market. That's a discouraged worker. That's somebody who in typical unemployment rates isn't included, but is somebody who in other circumstances would be willing to work. On that line of would be willing to work, there's marginally attached workers. People who aren't looking for work, but say, for example, a stay-at-home mom with a degree in accounting that could work, but has kids that she's got to pick up and drop off from school, take to appointments, after school soccer, there's a lot of stuff going on. And so she decides not to work. But she would say, hey, if you had a part-time work-from-home job that you could work during the hours your kids were in school, would you take that job? And if that's somebody who would say, yes, you're a marginally attached worker, somebody who would like to work or would be willing to work, but it would take a very specific thing. You're not discouraged, you haven't given up, you're just somebody who's not currently looking because of those circumstances. And the last one, which is, those 3 are actually those bottom 3 lines, they're all clustered together. They're actually fairly close together. They don't differ by very much. The highest one, that green one, is a really interesting one to me. That's underemployed due to economic reasons. And so this includes somebody, for example, I've been in this situation before. I graduated school, I was working as a server, and as a server, they don't care if you have a degree, right? They're not paying you for knowledge in economics or engineering or your nursing degree. None of that matters. So I took some time for me to be able to find a job that paid a premium for the specialties that I had, right? The other additional one could be that your hours got cut. You're working less hours per week than you want to, but there's just not the hours to go around. So when you look at that rate, we're actually at a 6.6% rate. I like pointing this one out just because I think the 3.6 in Utah, essentially since 2021, we've had really, really low unemployment rates. We had really low unemployment rates coming out of the pandemic. And to the point where economists were already talking about how the labor market is really hot, right? You're competing for workers. You're not really hiring unemployed people. To hire somebody who's already employed, you have to pay them a premium to get them to jump from the job that they're currently working over to your position, right? Which generally is a higher paycheck. So you've got this wage creep that slowly goes up over time. So that's in Utah right now, we're sitting at a 6.6% unemployment rate, which is the U6 one, different than the typical one we use of U3. But I point that out right now because we do see an increase in both. Now, really quick before I forget, these gray bars that you see all the time in economists' graphs, those are periods that have been defined as recessions. So that's why you have all those gray ones. On the far, far left over here in this one, it's the Great Recession. We had the 2020 recession in 2020 from COVID, and you'll see in a lot of my graphs, especially from the FRED, they just mark those for you. So Utah's labor market is cooling. Again, we've got that little gray bar on the left of where we had COVID activity. I cut it off there because really the last few years is the most interesting part of this. Again, don't be scared by the multiple lines. We'll walk through this slowly. There's 4 things they measure in this job opportunity and labor turnover survey. Now, keep in mind, it is a survey, so this is something that gets sent out to businesses and they answer. When we talk about job openings here, it's not a web scraper that's looking for jobs online. There's specific criteria around what jobs are allowed to be counted as job openings, and they don't include, for example, I've heard a lot of news lately about ghost postings or AI putting a lot of job openings online. These have to be real jobs that people can start within 30 days, for example. So these are actual positions. The 4 metrics that we're talking about right here are job openings, which is job postings, there's a position open. Hires, which is somebody is actually getting hired into a firm. These aren't necessarily new hires. They can be replacement hires, which is the majority of hires. But it's people entering into positions. You have quits, which is a voluntary separation. That is, I quit my job, right? If anyone remembers the news from a few years ago, there's a lot of talk about like the Great Resignation, a jump in quits. That economists were thrilled about that. That's a good sign. It means there's lots of opportunities in the labor market. People are leaving their positions and going somewhere else. That's beneficial for them. If you're choosing to leave your job, like I said, the majority of people who leave their job are hired into another position. It doesn't, for example, include retirements. It is quits. It's different. And then layoffs is the negative side of that. That is an involuntary separation. That is you being told, I'm so sorry, thank you for your time, please turn in your badge when you leave. So layoffs is kind of the one you want to watch for in terms of like unhealthy parts of the market. Now, starting from COVID, that gray bar, we had a huge spike in involuntary layoffs, right? People were told, go home, we don't need you. A lot of people were separated from their jobs for a short amount of time. You saw right afterwards, we have this little spike in hirings that goes above job openings. Well, that's people returning to their old positions. It's not necessarily just a random open job. It's them coming back to work, right? Quits dropped a ton because, again, quits is kind of a finger on the pulse of people's confidence. And when there was so much uncertainty at that time period, they were not confident in being able to find another position. So there was this big drop in quits rates as people decided, well, I'm going to hold on to the job I currently have. But fairly quickly, you see that quits line from 2020 up till a little bit into 2022. It's really elevated through 2023 and 2024. That's that Great Resignation period. And it follows pretty closely in line with this big jump in openings that we had post-2020, right? This is a ton of job opens. We hit above 130,000 jobs open within Utah, which is historically high. We've never had that many jobs open. So we returned back to work pretty quickly. Our metrics in terms of employment by the end of 2020 and beginning of 2021, we were above pre-pandemic employment. And so there's this big surge in activity afterwards. Just like Tim mentioned, when you have any kind of recession, it really can exacerbate things that are already in motion in the labor market. And so we see this big surge of demand afterwards. We see this big investments where people are willing to hire people back into the market. And layoffs remain pretty low. Now, he talked about this a lot, the federal funds rate, right? A simple way of looking at this as a lever, and here it essentially means when they raise the federal funds rate, usually in this case to combat inflation, which in 2022 we had that historically high inflation, they raised rates really quickly, and the idea is that they increased the cost of doing business, right? And as they increase the cost of doing business, businesses change their behavior. And you can see these job openings start to decline, right? As businesses change in the face of this changed market conditions, suddenly they're making less profits off the top, they're paying more towards the cost of doing business, and you see job openings decline a lot. And recently, you can see how they bottomed out quite a bit, right? They've changed. That's not historically abnormal if you saw a longer view of this, but it is different than the market conditions that we saw for the few years after COVID, right? In response, quits have kind of dropped from their highs of, above 60,000 down into more normal long-term rates of about 40,000 as people respond to this, right? There's just not as much opportunity, even as somebody who has a job, to switch from your current position into something else. Opportunities are decreasing. So in this, we've talked about it kind of as a low hire, low fire scenario. Nobody wants to talk about recessions. I don't think one's on the market or coming up right now either. But in terms of labor market, which is what we focus on the most, layoffs are what's called a lagging indicator, meaning they would always come later. That you as a firm, you don't want to let your people go. It's difficult to hire people back. It's difficult. It looks bad, right? It's bad for the culture to have layoffs. It has a lot of negative effects within your firm. So people hold on to people as often as they can, or as long as they can, and they just decrease that hiring. And when you decrease that hiring, you can't really offset natural attrition. Just the idea that people will have some turnover. People are going to switch their positions. People do quit and leave for reasons that might not even be job related. So when you have this low hiring mode, headcount does kind of dwindle a little bit over time, just as you don't offset the natural leaving of people within your company. What you can see, another metric of looking at this, for example, I should have had this one slide before actually. This is our employment to population ratio. So like I mentioned, you have your labor force, you measure people that are unemployed within that, right? But it only includes those people that are in your labor force, which generally in Utah recently has been between 67 or 68% of the population. What you can also look at as, well, what's our employment in terms of total population? Just the amount of people that are employed versus how many people are here. And you can see that despite our really low unemployment rates, after COVID, which is that giant dip on the far right, we came back to work pretty quickly and within a couple years had a higher percentage of our total population involved in the labor market. So it's kind of buried in this unemployment rate are some of these more complicated dynamics. And this is where we had a lot of opportunity. Again, this opportunity drew people into the labor market. And if you got drawn into the labor market because of a position, you keep the unemployment rate low because you just added to the amount of people employed, right? So we had this increase of people after the pandemic when we had all those job openings, all these different opportunities. We had workers within that were already within firms employed, switching to other firms that offered them more. And over the last couple of years, we've now seen a decrease back the other way, right? Again, this is all kind of masked under our consistently low unemployment rates, but it's diverged a little bit from the United States here too, which is unusual for us to drop more. Now, overall, we have had a faster trend downwards, but we do have a higher percentage of people employed to our population than the United States, and you can see that's essentially true historically always. Part of that is because he mentioned aging. We are not immune to this. We have an aging population as well. And aging people age out of the labor market and leave. And we've seen that affect the employment population ratio over time here. Another thing that you can kind of measure of how things are doing is unemployment claims. I do a lot of work with unemployment claims data. The two that we're looking here is just unemployment insurance, the initial claims, which does not even mean you're going to get approved for that claim. It's just people filing claims. And then continued claims, which is that your claim has been accepted, you're actually on unemployment benefits, and you're receiving those. Now, initial claims kind of sit here at the bottom. You can see there's not a ton of those. Continued claims are always higher because continued claims matter over time. The initial claims in 1 week will then trickle over the next few weeks, right, and be continued claims if they get accepted. And you can see the really strict seasonality. Those ups and downs, those are not huge economic events. That's just our yearly 12-month cycle, right? In Utah, everybody knows this, of course, too. In December, we always have our highest employment rates. We've got, school in session, you've got retail trade. It's before weather really impacts a lot of construction. And then coming out of that, you see losses in some of those seasonal jobs, and you see losses in construction, and the retail change after Christmas, all that kind of stuff kind of changes. And so we have this big burst of continued claims over the first part of the year. And usually in January, actually, you see a pretty big spike of people applying for it again, because it's kind of a rotating basis when you can get accepted. The takeaway from this whole graph is a couple things. One, I included back to 2008, so you have a reference. 2008 was a really harsh time to find a job. And you can see that continued claims in 2008 were higher than anything I'm talking about now over the last few years. That was a much harder time as an employee to find jobs if you got unemployed. But what you can see is in Utah, we haven't had huge spikes of big layoffs. I know I hear all the time about big layoffs across the United States, different companies letting go of a whole slew of thousands of employees at once. That would show up in our initial unemployment claims, and we haven't had any spikes in the last bit, right, here in Utah. So we're not seeing big waves of people being let go or anything, but what you can see is a consistent upward trend, seasonality aside, in our continued claims. And the implication there being that while we don't have huge droves of people being fired from their jobs, people that are let go are having a harder time getting back into the labor market or finding a new position for themselves. So it kind of goes in line with that dip in the openings rate that we saw. The opportunities are decreasing a little bit for the average employee. Our continued claims right now are over 16,000, which is the highest we've had since the pandemic spike back in 2020. Now, within the state, obviously, there's going to be differences between different geographies. Davis is the one that I'm a little sad about being at negative 1.3. You just always want positive growth. 1.3 isn't like a big decline, but we have seen losses within different industries up there, particularly government and manufacturing. But you can see the Wasatch Front in general has kind of hovered towards the state averages right now of growth. And I'm going to dive into the different industries and how they've been impacted. When we do the next slide, I just wanted to point out it's these 6 northern counties. I'm a regional economist too. I cover these 6 northern counties. You kind of have to cut out Salt Lake. Salt Lake itself is almost 2/3 of jobs within the state. We're a very, very urbanized state. We're one of the top 5 urbanized state, which means our population lives in a very small percentage of our overall land. So the Wasatch Front is really the majority of the economy. You do have pockets like, for example, Cache County is its own what's called metropolitan statistical area. It actually includes Franklin County in Idaho. And then Washington as well is a center of economic activity. But really, when you look at the majority of the activity in the state, it's the Wasatch Front, right? So we got to cut out Salt Lake to look at northern Utah and see how things are doing. And looking at just northern Utah, these are year-over rates from September 2024 to September 2025. The reason the timing is different than December is because December we get better averages and quicker averages essentially for state stuff because you're not actually, change over the month isn't that huge generally, versus when you narrow down and you try and get into smaller and smaller areas, it takes more time for good data to come through. And this is from QCEW. I have 5 minutes left. I'm going to have to speed up a lot. Okay, so for QCEW, counts 95% of jobs within the state. Essentially, there's some industries that really haven't been impacted a ton. And so, for example, like mining, we lost 10 jobs. That's 3.6% of the industry because it's a fairly small industry. But a lot of these fall into the area where you just see natural attrition kind of hitting more than anything else. The winners and losers here have been education, healthcare, and social services. We have an aging population. It follows national trends. It's the fastest growing right now, especially numerically. We've got 800 additional jobs there. Leisure and hospitality. Davis, for example, is our self-proclaimed Utah's amusement capital. And as people kind of restrict discretionary spending and decide to spend elsewhere rather than taking a more expensive trip over the state, they're going to go to Lagoon, they're going to go to Cherry Hill, they'll go to Sequest, they'll go to different areas there that have kind of buoyed up that leisure and hospitality. Government is a huge one up here because we've got the IRS building, the Hill Air Force Base, and then a couple different higher learning institutions like Weber and USU. Those buoy up government. Financial activities, because we've had such a hot, we don't have a lot of like investment banking up here, and because we've had a lot of, I'm thinking real estate, I'm forgetting the word, but yeah, because our housing market is fairly hot, mortgages and insurance have stayed fairly steady up here because that's a lot. Regional banking is really what we focus on up here anyway. Skipping down into the losers, manufacturing is actually the big one I want to talk about because I'm limited on time. But we've kind of pivoted over the last few years. We've got this really heavy investment in aerospace engineering. And we defied national trends for a long time with having manufacturing that was growing because across the US we've seen manufacturing employment decrease and we've had increases over the last few years here. We do start to see losses. Part of that is that we're switching, like I mentioned, to more advanced engineering, which requires a lower headcount and higher automation, higher involvement of technology. And we also have a national inventory correction where people kind of filled up their coffers, especially early 2025, and tried to get as much as they could in their warehouse and then didn't need more, right? They're just selling what they have. Okay, this one I pretty much have to skip over very quickly because I want to get to some of the predictions really fast. These are 2 graphs, or 1 graph with 2 lines. The blue line is the housing price index for Utah, and the green is the average household income. This I pegged to 2005, and so what you're looking at is just the percentage change or the change from that index time period, and showing that the growth in our household income has not kept up with housing prices. That has been true since before we've had this COVID bump. Obviously, there's a very steep incline in the housing price index post-2020 as demand skyrocketed, and then as the federal funds rate came in and they increased those rates, we responded to that with the HPI decreasing, housing price index decreasing. But our household income has not kept up over that time period. If you look at inflow and outflow to the state, in 2016, we started having inflow in migration, domestic and international, start to exceed our natural increase or the amount of kids we had. And that was very unusual. That's different than our historical trends, and you can kind of see that in this, that those people that moved in are new households, they want a home, and income in the area hasn't increased in tandem. Now, the back of the napkin math that a lot of economists use for how high should your income be for what kind of a house you pay for is kind of like a ring where you look at your annual salary and you do some math on that and think, well, this is what my price should be. And this one, what we've done historically is that the price you pay for a house should be about 3.5 your median income, right, or your annual salary. And over the last few years, in 2018, 19, and 20, we were already getting into fairly unaffordable housing. And since 2020, it's become really difficult for people to get in nationally. We've seen the average age of home buyers. In the 1980s, it was 29 years old to be the first-time home buyer. That stayed fairly consistent until the last few years and is now driven up to 42 years old as an average first-time home buyer, which is a lot older. And of course, when you're looking at, you know, an investment, which a house is, you're trying to pay that off, and the value of your house increases as gets buoyed up by inflation over time. It's really rough to have a shorter timeline, right? You don't want to be starting that late. And really quick, so Wasatch Front, again, we're very urbanized, so there's a lot of our state population that's just in this Wasatch Front area, but only 2.7% of houses have closed, or 2.7% of counties in the United States have median housing prices between $550,000 and $750,000, and everywhere in the Wasatch Front, barring Weber, is at that already. That's very expensive housing. If you look, the other counties that have these, again, are very urbanized areas. There's a lot of people competing for homes in these places. We're talking about the coast of California, like the Portland Metro on the west. We've got Seattle-Tacoma up in Washington. Those are all areas that are urbanized, and you have a lot of people competing for a small amount of area, but this is very unusual historically. If you look at like the 1990s, we weren't in the same boat at all, but it's changed for this new generation. It's difficult to get into housing. This is reflected in home. I'm like sprinting through this. I'm sorry because I have so little time. But yeah, this is home ownership rates. On the bottom, the blue is the United States. We get monthly metrics on that, and that's why it's much cleaner and has all these different points in there versus only the annualized numbers for Utah. But like I mentioned, in the 1990s, home ownership was increasing. Housing was affordable. Ever since the Great Recession, we've had a pretty constant decrease in that percentage. Now, I'm hoping our next year of data kind of brings that up again, and it's not that really big decline after 2020. But this is what we're looking at, that less people own the homes that they used to be in, which sucks because housing is a big part of your costs, right? This is one, I'll kind of blitz through the end of this because I know we're nearing the end of our time anyway, but this is housing burden. So when you're looking at a household, you kind of have expectations around what percentage of their income they should be spending on different goods. And one that economists look at is if you're paying more than 30% of your household income, which isn't just the household owner, that's all the income in the house. So for example, if you have roommates, they count towards your household income. If your wife works, that counts towards your household income. Or husband works, that counts towards your household income. So in here, on the left side is homeowners, on the right is renters. Really, you can see this big impact for renters. In Utah, for people 15 to 24 years old, 53% of those renters are household burdened. They're paying more than 30% of their income towards where they live. And it matters because if you're paying so much of your income towards that, you have less opportunity to pay, for example, an education, which is expensive, or to invest, which you really want to in the long term. The other point where you see, 40% and 42% isn't rosy either, but the other place you see really high rates is 65 and above, which is fixed incomes, right? And your rent keeps increasing and your income doesn't. So it is a rough time right now. There's actually, you can track this really easily through longitudinal employment and household dynamics, LEHD data that shows inflow and outflow of jobs from the state. When housing is affordable here, we have a giant influx of people. When housing is unaffordable, we lose young people to other states, right? Even though we have a young population. I have family members who moved to Texas because Texas is cheaper to buy a house and they can make about the same amount of money, right? So you do see that impact. Now, trying to look ahead, I'm going to blitz through these. ATMs and tellers. I wanted to talk about this because AI is always a concern. Is AI going to take everybody's jobs in 5 years? AI definitely is going to change how people do their jobs, but we've had technology influxes in the past. One example is automatic teller machines, which were expected to basically tank the amount of tellers that we have. And what we saw was that it decreased the price of a branch, of opening a branch in general, because you took the average number of tellers per branch from 21 to 13. It's almost a 50% reduction in headcount per branch. But because it made the cost of opening a branch cheaper, you actually saw, it's that top line up there, you saw the amount of tellers employed increase because now branches could open more locations, right? And what tellers did changed. Instead of just being a glorified calculator where you're just doing transactions and deposits and all that, now you're focusing on how do we get people into wealth management? How do we build relationships? And what they did as a job changed. We're going to see that same thing in Utah. We already see some examples of it. One is Denticor, for example, where AI comes in. It's a service around homeless and low-income people trying to get dental work in this mobile dentistry van. And they'll get x-rays done. The x-ray goes through an AI. AI goes to a dental hygienist, and then from a dental hygienist into a dentist, and then to insurance. What they've done is waive regulations on dentists looking at it unless the dental hygienist and the AI disagree. What that allows is a decrease in cost because you don't have to bill a dentist, and the dentist can now focus more on actual dentistry and do surgeries instead of sitting more and doing paperwork. So those should make a difference. There is a little anxiety. The 2 points here is the 52.9% consumer sentiment across the U.S. We're rosy in Utah. We've got an almost 80% consumer sentiment, which is pretty good. This is compared to pre-recession. So things that people are confident here. We're confident that within a year from now, our living situation will be better than it was. I'm sorry I'm going so quickly, but I'm out of time like 3 minutes ago. Anyway, these are, if you're interested, these are the Utah Economic Council. It's a mix of different economic predictions. It's spearheaded by the Kempsey Gardner Policy Institute. DWS puts their expectations in. We also have higher learning institutions that will put in their predictions. Utah's on the top here. The ones that are the good takeaways, total non-agriculture employment should increase by 1.5%. That's faster than this last year. Average home prices should increase. That's the one we disagree about the most, actually, I want to point out. CPI inflation should be 3.2%, but with an average annual pay, which is the fifth one down on the top, increase of 3.4%, you should still see real gains in wages. And that is it. Thank you for keeping up with me during that blitz during the end. I'm so sorry. There was a lot of stuff to put in. I don't know if we have time for questions or if we're going to just wrap up there. Okay, we'll take 2 questions, if anybody has some. I think Tim took all the good ones. Okay, well, thanks for keeping up with that sprint. If anybody does have any questions, please feel free to come talk to me afterwards. And like Chuck mentioned, I'm happy to come and talk to individual companies. I can give presentations like this for you guys. I'm a public employee, so it's easy and free to do. Just reach out to me. Thank you very much for your time. Thanks. Oh, you're good.
Thank you, Michael, and thank you, Tim, and thank you to all of you for coming with us this morning, having breakfast with us, and learning more about the economy and how it impacts our businesses. There's a survey on the table if you wouldn't mind taking that for us to help us improve these events every year. Also, these presentations will be available at bankofutah.com if you're interested in those materials. And then finally, if you haven't thought about Bank of Utah, consider us. Our mission is really to unlock our clients and our community's potential. And if you haven't given us a try, check out Bank of Utah. Thank you.
Photo?
Yeah. Yeah. Oh, thank you.
Probably devastated. I'm not very